The number one question I often hear is, am I on track and do I have enough? And honestly, it's no wonder we're confused. Scroll through social media and it looks like everyone is a millionaire. Then you see headlines saying that the average US household has over $1 million in net worth. And surveys claiming that you need 5.3 million just to feel successful. Meanwhile, you have higher grocery bills, rent, daycare, college loans, and a dollar that doesn't stretch the way it used to. So in this video, we're going to look at the real numbers so you can stop guessing, know exactly where you stand, and get clear on the money moves that matter. We'll cover 3 things: the real net worth landscape by age, the key strategies or levers to pull if your number isn't where you want it, and how to calculate your own enough number and sustainable withdrawals for the future. So grab your coffee and let's dive in. So first, a quick refresher here. Net worth is everything you own minus what you owe. So your cash, investments, retirement accounts, and home equity minus things like credit cards, student loans, car loans, and your mortgage. Now, if you want help tracking it, I've linked a free Notion net worth tracker in the description box below. And one more thing before we dive into the ages. I'm mostly using the median, not the average, because a handful of ultra wealthy households drag the average way up. So the median will show basically a better, clear representation of what's at the midpoint. Now, all of the numbers in this video come from the Federal Reserve's 2022 Survey of Consumer Finances, sliced by age and percentile using tools from Don't Quit Your Day Job calculator tools. So let's go. First up, the 20s. This decade is really about one thing: getting in the game. Net worth in your 20s is often messy, and that's okay. You're in entry-level roles, maybe in a high-cost city, paying rent and bills for the first time, and dealing with student loans. It's very common for net worth to be even close to zero or negative here. Using the latest data from households in their mid to late 20s, the net worth ladder looks very different from the headlines. At the 25th percentile, net worth is about $4,000, basically a small emergency fund, and many people below that are actually negative once you include student loans and credit cards. The median is roughly $30,000. Half of households in their late 20s have less than that to their name, and half have more. And the average is about $120,000. But that number is pulled up by a relatively small group of very wealthy young households, which is why I focus more on the median and about the percentiles when I talk about what's considered normal. And at the 90th percentile, basically the top 10%, net worth is close to $300,000. That's where you start seeing people who bought early in the stock market, got help with housing, or are building equity in a business. Now, if you're below the median or even negative, it doesn't mean you're doomed. It means you're early. In your 20s, the win isn't a perfect number. It's starting with the right habits. The earlier you start, the more time compounding has to work for you. So here are some key levers to pull if you're in your 20s. The first is to start investing in something, even if it's tiny. Aim for 15% of your income over time, but if that feels impossible, start with 3 to 5%. On a $50,000 salary, 5% is about $200 a month. Invested consistently in a broad market index fund, over time, you can grow that into a serious cushion. The second here is to avoid as much as possible high interest traps. Prioritize paying off high interest debt, credit cards, and student loans. Student loans at reasonable rates are more of a long-term bill. Not fun, but manageable if you have a plan and don't stack up too much expensive debt on top of that. The third here is to build income power through leverage. One of the best investments I believe that you can make in your 20s right now is to invest in skills that raise your income, but you need to layer in AI tools. Sam Altman, CEO of OpenAI, says that the real age now isn't memorizing facts. It's about getting really good at AI as your co-pilot. So the people who combine real-world skills plus AI literacy are the ones whose income power will compound in the next decade. So that's your 20s. Get in the game. Now, here's the hard truth about your 30s. I call this the squeeze decade. This is the decade where life gets full. Careers are much more serious. There might be a home mortgage, a partner, maybe childcare costs that look like a second mortgage. If your net worth line stays flat for a few years here, it's because you're just surviving the squeeze. And that's okay. So here are what those numbers look like for somebody in their 30s. At the 25th percentile, net worth is around $14,000. Basically a small safety net cushion, maybe a bit in retirement accounts, but not a lot of flexibility. The median is around $115,000. Now that might sound like a lot, but once you factor in home equity and retirement accounts, you can't easily touch that. It's not as liquid as you might think. So basically it's not spendable wealth as it seems. The average is about $380,000, but again, that's skewed by a smaller group of very wealthy households. At the 90th percentile, the top 10%, you're looking at close to over $700,000 in net worth. Serious investment accounts, real estate equity, maybe a business or multiple income streams. Now, if you're not where you want to be, the key shift here is that willpower alone is not a strategy. You need systems. So key levers here in your 30s. So the first here is to put your money on autopilot. You wanted to have it work in your background because life is busy. So stop saving from whatever's left. Set up automatic flows so every paycheck is split into fixed costs, investing at a minimum. Grab the 401k match, short-term savings, and enjoyment spending. Number 2, control lifestyle creep. As your income rises, especially with a partner, it's easy to upgrade everything. Upgrading some things are fine, but make sure you're also upgrading your future self. So don't let every raise disappear into lifestyle. Number 3, aim to be consumer debt-free by 40. No credit cards, personal loans, ideally just your mortgage. If you can hit this, your 40s will be much more powerful for wealth building. This is when someday starts turning into actual dates on a calendar. Work is more demanding, kids are older, and the question, will I ever be able to stop working, starts to feel very real. So the numbers here. At the 25th percentile, net worth is around $35,000 to $40,000. So a quarter of households are at or below that level. The median is about $175,000, which means that half of people in their 40s are under that line and half are above it. And at the 90th percentile, the top 10%, net worth is roughly $1.3 million. That's where you start seeing serious investment accounts, home equity, and sometimes business ownership. So the good news, the 40s are often your peak earning years, which means if you get intentional now, you still have a huge opportunity to move yourself up that ladder. And here are some key levers in your 40s. So first is to think about a financial audit. By now, you've probably accumulated a lot of money noise. So old 401ks, random accounts, unused subscriptions, insurance you haven't revisited. This is the decade to consolidate. Check your fees and make sure more of your income is actually going towards your priorities, towards your goals. A 1% fee on a large balance can quietly cost you 6 figures over the next 15 to 20 years. Second, you want to start thinking in terms of asset location, not just asset allocation. Put your highest growth, most tax-advantaged investments into accounts like Roth IRAs. If you're over the income limits for a direct Roth contribution, you can explore strategies like a backdoor Roth IRA or a mega backdoor Roth through your 401k, if your plan allows for it. And if you're a business owner or an independent contractor, consider adding a SEP or even a solo 401k to create even more tax-advantaged space for long-term growth. And finally, get a rough sense of your enough number here. If your ideal lifestyle costs about $80,000 a year, you'll want to plan maybe around 4% withdrawal rate that points you to around $2 million. You don't need to be perfect. You just need to have a working target so you know whether you're ahead or behind or on pace. Now, if you're looking at these numbers thinking, I have no idea if I'm actually on track, I do offer a limited number of free clarity calls where we can map out your enough number and your top 2 to 3 levers. Space is limited because I personally do this myself, so grab your spot if you're interested. In your 50s, you're in the red zone, the 5 to 10 years before retirement when every decision is magnified. So here are what the numbers show. At the 25th percentile, net worth is around $70,000, so a quarter of households are at or below that level. The median is about $295,000, meaning half of households are under that and half are above. And at the 90th percentile, the top 10%, net worth is roughly $2.6 million, where you see larger investment portfolios, paid off homes, or multiple properties, and sometimes business ownership. Now, if you're not where you want to be, here's some key levers to pull. First is to supercharge your catch-up contributions. The IRS gives extra room in your 50s to boost retirement savings through catch-up contributions in your 401k, IRA, and even HSA if you qualify. If you're behind, directing raises and bonus into these catch-ups is one of the fastest ways to close the gap. So I've put together a free 1-page contribution cheat sheet with the latest limits, and I keep it updated each year. You can grab that using the link in the description box below. Second is to build tax diversification, the 3 buckets. Most people have nearly everything in one bucket, pre-tax 401ks, which means a big tax bill later on. In your 50s, focus on building up your other buckets, tax-free accounts like the Roth IRAs and taxable brokerage accounts. Having money in all 3 gives you far more control over your tax bill in retirement and how to keep more of your money in your pocket. Last but not least, right-size your risks. As you get closer to retirement, a big market drop hurts more because you have less time to recover. So this is the decade to dial in your risks. You still want stocks so your money can grow faster than inflation, but you may also want to consider bonds and cash so that the ride is smoother. So a simple way to think about this is money you'll need to keep in the next 3 to 5 years, keep in a safer cash, high yield savings, short-term bonds, funds, money you won't touch for 10 plus years. This can stay more in stocks for growth. So roll over 401ks where it makes sense, simplify your accounts, and make sure each bucket of money matches when you'll actually need it. So this isn't the decade where a $7 subscription changes your life or a $6 cafe latte. It's the decade where investing an extra $1,000 to $2,000 a month does. Now, by your 60s, you've done the hard part. In this age group, the spread in net worth is huge. At the 25th percentile, net worth is around $75,000. So a quarter of households are at or below that level. The median is around $400,000. And by the time you get to the 90th percentile, net worth is close to $3 million. That's where you start to see multiple properties, large investment accounts, and significant business or equity ownership. This phase, while growth is still there, is less about accumulation and more about harvesting and having a clear plan for withdrawals, Social Security, and taxes. This is where you go from how big is my portfolio to how do I turn this into a sustainable, reliable paycheck that will last. That means deciding when you claim Social Security, how much you'll safely draw from your investments each year, and how required minimum distributions, RMDs, those forced withdrawals from traditional retirement accounts in your early 70s, fit into the picture so that taxes don't surprise you later on. Here's some key levers in your 60s. Your first is to design your paycheck and master the go-go years. Retirement spending usually follows a curve. Your early go-go years, when you can still travel and spend more. Slow go years, as life naturally quiets down. And no-go years, when health costs start to add up. So don't save everything for that last phase and miss the window to enjoy this first. Set up a sustainable withdrawal range, often somewhere between 3.5% to 4.5%, depending on your situation. Translate that into a monthly paycheck and have it automatically move from your investment accounts into checking. That turns your portfolio into a predictable income stream instead of a pile of big numbers on a screen. The second lever here is to coordinate your income bridge, Social Security and taxes. If you retire at 62, but wait to claim Social Security, let's say until 67 or 70 to maximize the benefit, you'll need a bridge, a bucket of cash or investments to fund those gap years. This is where your asset mix and withdrawal order really matters. Which accounts you tap into first, taxable, pre-tax, Roth, whether it makes sense to do small Roth conversions before RMDs start, and how all of that lines up with your tax brackets. Done well, this can lower your lifetime tax bill and give you greater flexibility later on. Protect your health and simplify your plan. In your 60s, financial security and health security go hand in hand. Make informed choices about Medicare, consider how you'd handle potential long-term healthcare costs, and make sure you have the right insurance for the lifestyle you want. At the same time, simplify. Consolidate accounts where it makes sense, update beneficiaries, and put key documents in one place, and write down your withdrawal plan in plain language. The goal is that if something were to happen to you, your spouse or your heirs could look at your accounts and your plan and say, okay, I know what this money is for and how it's supposed to be used. At this age, complexity is a risk. Clarity is a gift to you now and to the people you love later. So how do you actually figure out your enough number? Let's put this into practical terms. The first step is to start with your life, not the number. What does a good, comfortable life cost for you in today's dollar, including a buffer for healthcare? I have a free BCA lifestyle costs worksheet linked that walks you through 3 tiers. Your basic, basically your essentials covered, comfortable, how you'd like to live most of the time, and aspirational, the dream version. Give yourself permission to write down real numbers without any guilt here. The second is to layer in other incomes. First, you want to list other things such as Social Security, pensions, and rental income. And if your lifestyle target is $80,000 a year and Social Security covers, let's say, $30,000, your portfolio needs to fund the remaining $50,000. Step 3, use simple withdrawal range. So at roughly 3.5% to 4.5%, every $1 million can support you for about $35 to $45 annually without your money running out. If you need your portfolio to fund $50,000 a year, that points to $1.2 to $1.5 million invested. The next step is to treat it as a moving target. If you work part-time longer, downsize, or your expenses change, your enough number moves with you. Now, if you want a second set of eyes on that number, or you just want someone to help you translate all this into a clear next step plan for you and your walkaway number or your enough number, I'm opening a handful of one-on-one free clarity calls. In one session, we'll estimate your lifestyle range, translate it into a personal enough number, and identify your top levers to reach it sooner. I offer a limited number of spots because I personally do this. The link is in the description box below. Friends, thanks so much for watching. If this video helped you see where you stand, hit that like button, subscribe for more videos on building wealth and designing a work optional life. Now you can check out my next video here where we dive deeper into how many Americans have $1 million or more. See you in the next one.